All right, we're going to get going. Well, good morning again. My name is Josh Stripmatter, and I would like to welcome you to Stripmatter Wealth Smart Money webinar series. Thank you for joining us today. Our presentation is titled Increasing Income and Inflation Hedge. For those of you that don't know us, we are Stripmatter Wealth Management Group, a registered investment advisor located in downtown Fort Worth, Texas. We specialize in investment management, financial planning, and estate planning and real estate investing. We've been in business since 2007 and serve clients throughout the United States. A little bit of housekeeping before we get started. All of you have access to the chat feature. So if you have any questions, please don't hesitate to type those in and we'll be happy to answer those for you. Also, we'll be sending out a replay of today's webinar via email. So if you miss something, don't panic. You'll have the ability to watch this again. And you are welcome to forward these presentations and any of our presentations to your friends and family if you think it would be beneficial. Today's webinar is meant to be purely educational and not meant as tax or legal advice. Please talk to your licensed professional before taking action on any of the information in this presentation. For more information, including key disclosures, please visit our website at stripmatterwealth.com. Now let me introduce our speaker today. Jesse DeHealy is an investment specialist for Allianz Life, where he provides education to investors and advisors on various financial topics. Jesse graduated from St. John's University in Collegeville, Minnesota, with a bachelor's degree in business management. Outside of work, he enjoys spending time outdoors, fishing, and camping. So without further ado, let me introduce Jesse to you. Good morning, Jesse.
Good morning, and thank you so much for having me here today. As Josh said, we are going to discuss increasing income and how inflation ties into that. And as we go through today's presentation, be sure to use the chat feature for any questions you have. Be happy to circle back to that at the end of the show. So, increasing income and inflation. Inflation's been on everybody's mind, particularly over the last 12 months. We've had some huge increases in inflation, and again, this presentation today will talk about the benefits of having an increasing income opportunity with that inflation protection. So let's take a look at, oops, go here. Sorry, the computer's getting a little wonky. There we go. So let's take a look at the effect inflation might have on your overall grocery bill.
Jesse, actually, the presentation's not up.
The presentation's not there. One moment. Let's try to get this to go again. Can you see it now, Josh?
I can. Thank you.
All right, perfect. Sorry about that, folks. But so on your screen here, let's look at a basket of goods, your grocery bill. A $20 bag of groceries in 1980 has obviously increased since then. By 1990, that same grocery bag of that you had there has grown over to nearly $32. Jump out to today, 2022, that same grocery bag is now going to cost you $68. That's a heck of an increase, and it's only getting worse based on what we've seen over the last few months with food costs. Inflation dominates the news. There's not a website, news-related website, I should say, you can go to that's not going to have some article on inflation. Inflation is everywhere, and it's something that we definitely need to be concerned about and aware of as we go through our retirement and how that might impact your retirement plans. This is an interesting slide. Allianz does a survey every year. We call it our New Year's resolution study. And we look at and ask individuals, what are some of your greatest concerns as you head into retirement? Well, this being a topic of inflation today, inflation is the number one thing. 2020, only 8% of the respondents said that they were concerned about inflation. That number is nearly tripled. 25% are now concerned that inflation is going to have a huge impact on their retirement plans. Outliving your money's still there, but has actually decreased a little bit over the last couple of years. Healthcare costs, which are very important and continue to go up, that's lessened. And then job security. Most people, as they head into retirement, ideally they want to stay retired, but they know that, particularly with the economy today and all the open jobs out there, that job security probably isn't much of a concern. It's inflation. If we look at inflation throughout history, and I'll actually give you a time frame here, from 1914 through 2021, inflation averaged about 3.25% per year. There's been very little change over the last 30 years until just recently. Now, how might that impact one's overall bond holdings, for example? To show you a drastic number now, obviously the 10-year Treasury is a little bit higher than 1.4 right now, but let's compare this to inflation. This is the largest gap that we've had between inflation and Treasury bonds in nearly 40 years. Inflation, 6.8%, let's call that SEP. 10-year Treasury right now is about 275, 280 as of this morning. But again, that is still the largest gap that we've seen between those two numbers in over 30 years. Now, we might have a solution for you. Increasing income opportunities. What we're going to dig into over the next few moments is, one, how increasing income on an annuity could work. Also, we're going to look at the data to back the strength of not only the offerings that we have our products here at Allianz Life, but how does that relate to inflation and how do those numbers compare? First, what are some of the benefits of a fixed index annuity? Well, you have that principal protection. Your asset can grow and not go backwards in value if we do have a market correction or a recession. Tax-deferred growth. You're not going to have to pay any taxes on the gains until you start to withdraw those assets. I touched on the growth potential a few moments ago, so you can grow your assets in a safe environment knowing you're not going to go backwards. We also have potential to offer death benefits to pass on to your heirs and income that you can't outlive. Particularly, we're going to discuss today increasing income that you cannot outlive. Now, a few disclosures. Based on the product, there may or may not be fees for the rider charge to get that lifetime income, and you may be subject to holding periods before you can access that. So, Allianz has really been a leader in the increasing income space. We entered the increasing income space in 2008, and we do it unlike anybody else. It's a unique way, which we'll touch on in just a few moments here. But essentially, you're going to get a pay increase anytime that there's an index or interest credit to your account during the withdrawal phase. The next thing I'll point out is that these income increases are permanent. Once you hit that new mark of your income, your payment cannot go back down. And another great feature is that you can continue to get pay increases even once you've drawn down the asset to zero and you're in the insurance company's pocket. That's not available everywhere, but a great benefit to know that as we all live longer and you draw down your assets, you can continue to get pay increases. One example I've shared with individuals is, think of it as a job that you can't get fired from, yet you still have the ability to get pay raises each and every year. It's a powerful statement as we go into retirement and are spending now 20, 30, maybe even 40 years in the retirement phase of our lives. We want to make sure that you have income you cannot outlive. So one of the unique features about annuities in general is an index lock, or not index lock, but an annual reset feature. What that means is that this year's ending point is the next year's starting point. Or you could also say, you're not going to ride any downturns in the market. Your worst case scenarios, you're going to be left off where you were. So in year one, as you see on the screen here, index went up slightly. That's locked in. It's now your worst case scenario from a value standpoint. Now we jump out a few more years. The index has dropped. Let's just say that we entered this recession that they're thinking might happen in the next year or so. Well, your value here remained the same. You have the protection of the annuity from downturns in the marketplace. And as soon as those markets come back, You don't need to wait for that value to come back to here before you can see an increase. As you heard me say a moment ago, last year's ending point is this year's starting point. So as soon as that index goes up again, you're going to get that positive credit. And again, that's your new worst case scenario locked in. Now let's put some numbers to this example. Let's take a look at somebody drawing a lifetime income. They start in year one, $25,000. Again, this is a hypothetical example utilizing a 5% withdrawal rate on an asset worth $500,000. First year's income, $25,000. Now the index in this case, we dropped. Your payment remains at $25,000. Now we've had a little bit of an increase. And we didn't have to wait for us to get to the even line again. As soon as you get an increase, that'll be credited as a positive credit to your paycheck. That $25,750 becomes your new worst case scenario. And market drops, or holds steady, carries on, goes up again. And again, each and every year you get that increase on your index or interest credit, your payment goes up and stays up. It cannot go back down from its starting point. So let's take this a step further. Let's consider inflation and the impact it has on your purchasing power throughout retirement. So we're assuming 3.25% inflation. We're going to use $10,000. Well, 3.25% inflation by year 5, you've eroded some purchasing power. You're down to 88% of that. So $8,800. That same $10,000 is worth $8,800. But again, we're all spending longer than 5 years or so in retirement. Let's jump out 20 years. Nearly half of your purchasing power has been eroded in this situation, assuming standard inflation that we've experienced over the little over 100 years. By 30 years, you've lost 40% of your purchasing power. Now let's look at the same thing, but with an annuity. We're still going to use the 3.25% inflation, but let's assume a 3% rate of return on the annuity. Well, after 5 years, you're still doing all right. Your purchasing power, you're at 105%. That same 10,000 is 10,500, let's call it. Jump out to year 20. That same $10,000 is now worth $12,568. Year 30, a bit over $14,000. Well, any annuity or product out there can't promise that you're going to keep up with inflation. These products do a fantastic job of lessening the worry and reducing the impact that inflation might have on your retirement plan and retirement income. I had mentioned healthcare earlier. Some of you that are already in retirement probably understand healthcare is expensive. It's going up 5-6% per year. Well, we can get ahead of this through an annuity and try to plan a budget for that. But let's look at it in dollars terms. Again, same thing we saw a little bit ago. We're going to start with $10,000. Assuming we're just over 5% inflation in healthcare, by year 5, that same $10,000 is worth $8,200. Go up to year 20, $3,900. But if we throw in an annuity into the mix here with the opportunity for an increasing income, and again, we'll use a 3% return here, you can see the numbers on your screen are helping to keep up, not necessarily exactly, but help do a better job of keeping up with the rising costs of healthcare. Would you rather be in a situation where you're 25 years out and that same $10,000 only bought you $3,000 worth of care, or have the benefit of an annuity with increasing income where at year 25, that same $10,000 provided you with about $8,800 in care? Now you might be wondering, particularly with insurance companies, yeah, you tell me you offer increasing income, but do you actually do it? Well, we do, and we're happy to show you the numbers. 99% of all of our policy owners that have elected an increasing income opportunity have received an increase in pay. Of that group, clients 67% of them have received a pay increase every year. And I'll say real quick off that is if you elect to the fixed interest account, you can guarantee yourself some form of step up every year. But again, that's a strong number. 67% of our policy owners receiving an increasing income opportunity have seen an increase every year. Now, for those that are out there that have maybe just started their income early on, 94% have received more than one increase in their pay. Again, powerful story as you take a look at your own retirement, living longer, the impact inflation might have. An increasing income opportunity is a good fit for your retirement needs. So how big have these increases been? We're looking at a chart here. We're going to show the total number of years that they have an opportunity for an increase, or in other words, how long they've been taking an income stream off of their annuity. We have a column line here that shows the total average accumulated increase. And then we also have a range. Now, this is total range. Historically, I would tell people, again, no guarantees here, but a reasonable expectation of return on annuity is going to be between 3 and 5%, maybe even 4 to 6% in great times and strong times of the market. But if we look at this chart here, just year one, the range of increases was about 2.5 to almost 5.5. And again, if we consider the inflation rate over the last 100 or so years of 3.25%, that's pretty good. The other thing I like to do is go all the way out to year 12 and show, again, historically, these are real numbers, actual policy owners, the average total cumulative income increases in excess of 50%. So now, again, we're going to look at numbers again. Obviously, this is a very numbers-heavy industry, so let's look at years where you're getting average income and we're average inflation. So your increasing income opportunity here, year one, yeah, inflation may have slightly outpaced that, but you're pretty close. Again, you'll see that stretch as time goes on, that eventually, yes, increasing income will help exceed normal rate of return on inflation, or average increase in inflation, I apologize. Would you rather be in a situation where you're getting 1545 in year 12, or have that impact where inflation has eroded your purchasing power and you're actually less than what you started with? Let's look at the same numbers, but in a period of high inflation as we are today. Again, we saw on the chart there was just shy of 7%. The most recent figure, if I remember right, was just shy of 9% last quarter. In that case there, yeah, you'll be behind on your income early on, but over time, those benefits of the step-ups that you are eligible for every year based on index and interest credits are ultimately going to help you have a more reliable and stable retirement. And then last, because we want to cover all of our bases here, let's talk about lower income starting dollar amount and, again, high inflation. In every situation over time, you are going to be better off. And again, that's very important as we go live longer in retirement, that you are trying to at least keep pace with the cost of, cost of living, I guess is the best for me to say. So in summary, inflation is a major concern. Historically, again, 3.25% since 1914. The last year or so, we've seen 7, 8, 9% inflation. Again, that is a concern for people as they hit retirement. They've already formed their plans in a more, favorable environment. How can we get ahead of this and make sure that those monies are going to last you for your life and not erode your purchasing power? Increasing income, and a lot of you guys might already have products that do this, and the permanent increases that you receive on income are fantastic. Again, payments can go up, but they can't go back down. And historical data shows we do give pay raises. You have the ability to get pay raises, and if we compare that to historical inflation and even the more recent inflation trends, we're going to see that we're going to help address those concerns for your clients and their plans. We do have some material on this available to you. Feel free to reach out to the team and they will send this your way to show you the strength of the increasing income opportunity and why it's important for your retirement plan. And with that, I'm going to turn it back over to Josh and let's see if we have any questions that we might be able to address for our team today, our listeners.
All right, Jesse, thank you very much. That was very informational. And if you do have questions, feel free to type those into the chat feature, and then we will address those questions today. While we're waiting for questions, if you have questions beyond what you'd like to talk about in this presentation, you're welcome to give us a call at 817-210-3444 or email us at clientservice@stripmatterwealth.com. Also, we have a great weekly market update e-newsletter for people who would like information on the markets. We also have some great newsletters that are less frequent. We have a monthly retirement newsletter as well, and then we have an events newsletter. Also, I'm on the radio every Saturday at 10 a.m. on 1190 a.m. on a show called Ask the Experts. So if you'd like to listen to me answer some questions, feel free to tune in, and then we also post that to our website if you'd like to listen to it later. Okay, I'm not seeing any questions. So Jesse, well, here's one. So we have a question. It says, is this one for people who are already receiving a payout? I'm assuming, so I can speak a little bit to that, Jesse. I guess it depends upon the type of annuity that you have as to whether or not this has a feature to it. And when you have the feature and you begin your payout, the rider, because this is an income rider, will begin that increase where it looks at it each year, the value each year, to determine whether or not you receive the increase. So the increase comes from the rise in the index value. So hopefully that answers your question. What happens if you pass away during the payout? That's a great question. Jesse, I'll let you handle that one.
And that is a great question. Any dollar value left in the annuity upon death is passable to the beneficiary. Now, in the past years, before 2008, annuities typically required annuitization. And if you did a lifetime annuitization, once you passed away, there would be no more death benefit. Annuities have come a long way in their development, and with an income rider, they are set up today with any remaining value is passable to the beneficiary.
And then you can also choose an option where you can choose a joint payout to where it pays out to both parties. So at the first death, it pays out to the beneficiary for the rest of their life.
And that's a good point. We didn't really touch on it, but yes, you do have options for joint income as well. It'll pay for both lives, and same deal, any remaining value does get passed on to the beneficiary. Thank you, Josh.
You bet. And then a follow-up to the first question, people who are already receiving a payout and retired already, again, this would apply to you if you invested into an annuity that had this feature, and then you started that feature, and so you could start that feature right away. I think maybe that's your question. Can you get this right away? And Jesse, you can speak to that.
You broke up there, and the question, what was that? One more time, Josh?
Yeah, the question is can you invest into an annuity like this and receive that payment right away? In other words, can you start that rider right away?
Depending upon the product that you go into, yes. We have options where you can start income straight away, and others that require a holding period of, one in particular, a 10-year holding period. But in exchange for that, you might get some enhanced growth opportunities and additional index options. But direct answer to your question, yes, the flexibility to start income really at any contract anniversary in most cases.
Okay, and a follow-up question, what kind of return do you get before you start drawing the income?
So that's a little bit more difficult to answer because it's going to depend upon, of course, market conditions, the allocation options that you choose. Generally, I would say as a reasonable expectation on an annuity, you can expect between 3 and 5% per year.
Yeah, and I agree with that, Jesse. I think these are very conservative investments, folks. So these are not meant to essentially keep up with your stock market portfolio. So they're meant for people who are interested in investing conservatively, because one of the great benefits of the fixed index annuity is that you can't lose your principal. And then also that the growth is just that, again, 3 to 5% growth is what you can expect from this over time per year. And then beyond that, people who are interested in having an income stream that's paid out to them that has the ability to inflate. And from what I've seen over the years, that's been hugely beneficial to people to help fight inflation. That's one of the things that I think is probably most beneficial about a fixed index annuity today is the income feature that provides that guaranteed lifetime income, and then also for the ability for the income to increase and fight inflation with those increases.
And Josh, I'm going to add one thing that I didn't touch on in today's presentation, but some of our contracts do offer what we call an index lock feature, where you could lock in gains mid-year. And what I mean by that is, let's just say you're allocated to an S&P index that we offer. You're in the middle of a contract year and you see the index itself is up 10%. Well, you could go in and lock your account, and we'll credit that to you on your anniversary. So it is possible to obviously do a little bit better than 3 to 5%. But again, flexibility and control of the asset is really what you're getting with an annuity.
Yep. And another question from William Kennedy. If the current financial conditions take 5 to 8 years to come back to historical 3.25% inflation, how does this affect your numbers? And I can speak to this, Jesse. So I think the idea is that if I invest in this now and inflation stays at 8%, I will not perform as well as inflation. In other words, I won't be able to get above inflation. And so what I think will happen is that you'll see inflation come down as the Fed is raising interest rates right now. That's their sole objective, is to bring the inflation numbers down. And so as that occurs, you'll see inflation come back down again. And then I think it'll get more close to the 20-year average, which is somewhere between 2 and 3%. And then this would be beneficial to you. Another point I would make too is that I always kind of compare this to a pension. A pension is nothing more than annuity. And so when you're looking at most pensions, they don't have an inflation benefit built in or an indexing benefit built in, meaning they don't increase each year. So relative to your pension that you receive from your company, that's just a flat amount for the rest of your life, that's really what you're comparing this to, is a guaranteed lifetime income that actually goes up each year. So in that regard, it's a great tool to help and fight inflation relative to just another pension that you may have. So I would say, again, I think inflation is going to come down to where this would benefit you, at least help you to stay even. But number two is I always think of this as a pension. And for people who would like to have a lifetime income, I think this is a great solution. And then again, it's an even better solution than most other fixed index annuities, because it has an income rider that will actually help it inflate. Okay, we're going to keep going here. What's the basis for your historical inflation rate starting point of 1914, Jesse?
All right. So that is actually actual data. You asked, why did we choose 1914? I believe that's when they actually started tracking inflation officially. I might be wrong on that, but we did want to just give a broad range, which is why we did choose, a little over 100 years on that average of 3.25.
Okay, next question. Can you transfer a 401k cash balance pension to this type of annuity? And I can take that one, Jesse. So the answer is yes. When you transfer from a 401k to an annuity, just a couple of things you need to be aware of is that there's no additional tax benefit. So your 401k already grows tax deferred. So just like the annuity would grow tax deferred as well. You are still subject to requirement of distributions. So the annuity would be subject to distributing to you at your age 72 for requirement of distributions. And then beyond that is you need to do a good comparison between the two. Now, I would also say, you said cash balance pension plan. I want to make sure that we're on the same page. Typically, when I hear cash balance pension, that's different than a 401k. So a cash balance plan is a pension plan that you can actually transfer to. You can actually take all the money out instead of taking an income from your pension. You can take all the money out and roll it into an IRA, and then you can invest it however you want to. And so this can be an IRA annuity, and you can. And the answer is yes. You can still do the same thing. You obviously want to compare the two to make sure it's a good fit for you, but the answer is yes to that question. I have somebody that raised their hand. Let's see here. If you please type in your question to the chat feature. I don't have the ability to see what your question is. See if I've got any other questions here. Hopefully those answered all of your questions, folks. I'll wait just a minute for this other person to type in their question, Jesse.
Yeah. Oh, no problem.
Okay. Well, again, if you have any questions, feel free to just shoot us an email, and I'm happy to answer any questions that you have. Other than that, thank you very much, Jesse. We appreciate your time and look forward to having you on again in the future. I hope everyone has a great rest of their week. We'll see you next time. Thank you.